and welcome to this panel. So I'm Anne-Laure Béagle. I'm the Client Protection Pathway Director at Cerise+SPTF. And it's an honor for me to be moderating this panel about the role of investors and boards in strengthening consumer protection through their governance. So joining me today, this morning, to illustrate this topic, I'm lucky to have representatives of equity investors, all leaders in the impact investment landscape, but all very different in their approaches. So we have Jon Saleh is the Social and Environmental Performance Manager for CD and Social and Environmental Manager for FSPs. He also used to manage the Finansol label, the oldest label for responsible finance in Europe. He is also a Cerise alumni and has two wonderful little daughters. He wanted me to mention that. Then we have Vidari Intamon, who's working at Gojo Holding Company in the fundraising and treasury team. She is a board member of Maxima in Cambodia and is also a client protection qualified trainer with Cerise+SPTF. Then we have Milena, who is the head of financial institutions at BIO, the Belgian DFI. She is responsible for investments in debt and equity in banks, fintechs, leasing, and microfinance companies. BIO is a global impact investor with close to 1 billion euro in assets under management. The financial sector represents 50% of BIO's investments in debt and equity. And then we are also fortunate to have with us Daniel Rosas, who, apart from being a member of the e-MFP team and founder of Mimosa, he has also spent the past 15 years working on client protection, including writing 3 papers on responsible exits. So I will start this conversation that we are going to have by just to set the context somehow, if you could, each of you, and maybe we'll start with you, Milena, explaining a bit more about what your equity investment strategy is and how in this strategy, how do you incorporate client protection criteria?
Sure. Hello, everybody. It's a pleasure to be here. Thanks for joining us. Yes, indeed, BIO has an active strategy towards direct equity in the financial sector. So we have a portfolio of around 12 investees across Latin America, Asia, and Africa. This is a mix of microfinance institutions, holding companies in banks and microfinance institutions, banks, and very recently insurance company as well. Those companies are aligned, of course, with our strategy in terms of financial inclusion and SME financing. Basically, when BIO provides capital to a client, we want to be patient. So what I mean by patient is that it's patient doesn't mean permanent, so that means that at a certain point we need to exit. We are there for time horizon, but at a certain point we will need to exit. We have a preference for primary than secondary capital. We also want to have a significant minority stake, which means that we want to have a role in the governance of the company, so we want to have a board seat. And then we also accompany our investees with technical assistance, basically to accompany the work on strategic topics. On your question about how we incorporate the CPP criteria in our selection process, I would say we start with a market need. So basically, for us to invest, it should be a need on the market that cannot be filled by a more commercial investor or cannot be filled for a local investor. So there is a role for us to play in terms of financial additionality. Secondly, should be a business case. So we call it an investment thesis. So we are going to look the project, the risks of the project. We are going to look the return of the project, but we are also going to look what we can do with this project in terms of impact, in terms of development. We are going to do an ESG assessment to see basically where the company stands in terms of climate protection principle, gender, climate, and you know, those social topics. And then I think one of the components that are quite key for us, but it's very difficult to quantify, is the potential for relationship. And what I mean by that is that at a very early stage, it's very important to have this conversation, possibly face-to-face conversation with the sponsor, with the funder, to understand how they see the company evolving, to understand what are their values, and basically to have a common vision with them, to align on this, and how we as an investor, you know, can accompany this vision. I think on this, if these three dimensions are covered, I think we could be very enthusiastic to work with the institution. And so basically what I want to say, it should be a willingness of the institution to work towards best practice in terms of CPP.
Okay, very interesting. Thank you, Milena. So I do understand that there is a moment where you stop and you watch the potential investee in terms of values and aligning values of what bio wants and what the MFI, let's say, or FSP is able to show to you. Interestingly, I think Gojo also has an approach, a specific approach that identifies values when you conduct your investment proposal. Could you explain this a bit more?
Yes, thank you, Anne-Laure. Let me introduce briefly Gojo. So Gojo is a Tokyo-based company. We expand our footprints through the investment and acquisition of financial service provider. To date, we are invested in 5 countries through 9 companies, and we recently entered in Africa through the minority acquisition of Baobab, though our core investment strategy was in Asia. To date, we have raised about $325 million paid in capital and recently raised $100 million in debt. And we serve about 2.4 million clients as of today. So to reply to your question, Anne-Laure, indeed, whenever we carry out due diligence for a potential investee, it starts from the pre-screening stage. So it means that as a matter of principle, the investment department will never look into a investment that has a potential misalignment on social performance and client protection. So whenever there is a due diligence that starts, before even we are issuing a non-binding term sheet, the SPM team is being sent on the ground to carry out a very light due diligence using a Linus. And once a non-binding term sheet is being issued to the potential investee, a full alignment is being conducted, in addition to our own framework to assess product suitability, client satisfaction, etc.
Sorry, can you define aligners? So, or maybe I will, just because for those in the room who don't know, aligners is a tool, a Cerise+SPTF tool that is mainly used, that has been created by the Social Investor Working Group, and that is mainly used by investors in their due diligence process to identify the client protection key aspects of due diligence, as well as a few social performance indicators. And please, sorry for interrupting.
And once we have all this set of, I would say, the aligners and our own framework assessment, then we go through the investment committee of Gojo with this SPM very much highlighted, and if it passed to the investment committee, it goes to the board of directors for final approval.
Okay, so you are indeed, you have a standardized, that's interesting to hear, a kind of standardized way of approaching your due diligence and your identification of equity investments. What could you say, Vidari, to follow up on? What do you try to achieve with your equity investments?
So whenever we do an equity investment, the purpose is to set very high standards at partners level. So it starts we are having actually a very strong team at Gojo. On the SPM, we are like about 40 people at the holdco, 5 are full staff members for the SPM and research team. And thanks to that, we have a very close follow-up at partners level. The partners are the company where we invest. And with this, what we require from them is to have a SPM lead that is being identified after 1 year, once we did the majority investment, is to have also to aim for a certification, whichever the level. The purpose of having the certification is not to have the highest level possible, it's just to start with an assessment so that then the SPM team from Gojo can help them to assess the gaps and to move on to improve their performance towards client protection. And last but not least, we are asking them to have a SPI, which is completed every 3 years.
Yes, okay, thank you. And Milena, I also understand that you try also to be a game changer in doing. Could you explain concretely what you try to achieve with your equity stakes?
Sure. I think we really try very hard to play a catalytic role in our investments. And in most of the investments at Bio, we enter in an early stage, I will say, when the institution is not really very mature. And then the objective basically is to create value. How we try to do that, basically, it's we discuss with the institution in a very early stage. We discuss also with potential co-investors how concretely we want to create value. So in our shareholders agreement, there will be a section where we draft a value creation plan. And what is a value creation plan? It's basically a plan, of course, in the long term, where how we see different strategic topics that are really important for the company, such as client protection principles. So basically where we are today, how we can move towards best practice is a sort of roadmap towards achieving certain metrics that we want to achieve. It could be impact, but not only. We can talk about digitalization, we can talk about risk, we can talk about governance. So it's quite broad. I think value creation plan, our experience is that implementation, it's really a long-term work. You need a lot of discipline, you need a lot of hands-on work to be able to achieve what you expect. But I think having this value creation plan in the shareholders agreement as a contract helps a lot, I think, to have a framework of creating value.
Great, interesting. Thank you very much, Milena. And now on to you, Jon, to present maybe CD as you have a unique way of investing. Would you like to also, present what CD does in terms of equity and what makes you so special?
I don't know if we're special, but I'm very happy that you're highlighting that. So CD has been existing as a social investor for 40 years. We invest mostly into microfinance, like rural microfinance institutions and agriculture entities, mostly in Sub-Saharan Africa and South America. So we have 125 partners on which we are invested on 100 of them. So there are 25 that we're not invested in, but we provide them with technical assistance to prepare the moment when they're actually strong enough to be invested in. And among the 100 investees that we have, we are invested in equity into 35 of them with minority stakes and a seat at the board level. Our portfolio together, CD has 35 billion euro of assets, and we're advisors of a debt fund called FIFISOL2, on which we're leveraging, of course, the investment that CD is doing. And we owe an investment society in Uganda, for instance, which is invested into 23 microfinance institutions. And we owe also an AIFM located in Belgium. Yeah, that's, let's say, the heart of what we are doing right now. In terms of type of, when we invest into MFI, what we seek is a partnership. It's a long-term partnership, so we don't have any exit horizon. We stay as long as the vision of the partner is aligned with ours. And usually the organization is extremely weak. They can be operating in very complex contexts, for instance, in North Kivu, where we have a few equity stakes, and we still take equity investment in this area, for instance. And in those type of organizations, sometimes they have been there for 20, 30 years, so they have shown the capacity to, to take all the shocks that are happening in the region. They can have, usually they're tier 3 microfinance institutions. They're not very small institutions, but they're not big neither. And they are kind of old and heavy, and they have all the defaults that we know of older institutions. And this is where we stand, basically. So the first issue for us, of course, is to work with them towards variability, try to modernize the way they work, and push also, of course, this subject of social and environmental performance management and client protection, even though it's always, a balance that we're looking at. As very often, those institutions may be lacking data collection capacities, and when they can collect data, when they struggle to use the data, and when they succeed to use the data, they struggle to make decisions based on those data. So it's a very long process. Sometimes works, sometimes it doesn't. It depends a bit on the situations, and we have plenty of situations. We are invested, for instance, into Centenary Bank for 30 years. We have been there when it was a very tiny organization, and now they have 3 million clients in East Africa, so it's the largest microfinance institution in Africa. And we are a very active investor, even though we have little stakes in this organization, and we have been there throughout the time, and supporting them when they had difficulties, supporting them when they needed to make difficult decisions, for instance, starting to invest in other countries and create subsidiaries. And for that reason, they appreciate very much our role, and we have a very specific relationship with the founders and the managers of the organization.
Good, indeed. So what I really hear here is this key thing in taking an equity stake is the alignment of the investor and the FSPs in terms of values and mission, and the wish to really partner and work together. I also understand that you make it a duty, probably all of you, to have a seat on the board, either yourself or through independent board members who represent your organization, right? Maybe I will start with you as well, Milena. How do you, by taking this space on the board, even with a minority stake, how do you embed the client protection or a client-centric culture into the governance of the FSPs you accompany?
Yes, I think what it's important for us is to have certain concepts clear, and where it starts, it's that we need to be aligned with the company and with the staff and with the management in the fact that MFIs are double-button institutions. What I mean with that is they have, of course, a financial objective, but also social mission and social objective. And this social mission should be seen as a priority in the company. So if the company is aligned in terms of, have a clear vision and mission which is focused on its clients, I think that facilitates a lot the work. Secondly, in terms of the role of the governance, and I think we also need to align in terms of what are the responsibilities of the board, what we expect from our board members. I think you agree with me. What we expect from our member is to support the strategy of the company, to accompany the risk appetite of the company, and so on. But there is also a strong role from them in terms of, when it comes to ethical values of the company, when it comes to the culture of the company. So the board should play a role in safeguarding the social mission of the company. When this is clear, I think that enormously facilitates the work. And then, as a next step, I think it could be useful to use some metrics. I think we are used to see at the boards these metrics on, financial performance, evolution of the company, but not too much some KPIs in terms of, social success of the company. I think it's really key to have this conversation and to see how the company has been able to evolve in the social objectives. And then in terms of culture, I think because you mentioned as well on your question, I think the role of management and staff is absolutely key. So they are the ones also having, the CPPs alive in the company. And I think it's a bottom-up and top-down approach. So it comes from the staff, from the management, but also from the board. That will be my answer.
Thank you indeed. I think also at CD you also have a strong mission into bringing client protection and social performance topics on the agenda of boards where you sit. Would you have any example of somewhere where a client protection topic has been indeed brought and voted at the board level?
What is a bit specific with CD is that, for instance, this topic of social and environmental performance management and client protection is not pushed by me and my team, for instance, into the SCPM department, but by our partnership officer, who we train and support, in the capacity to engage with the boards of all the institutions where we sit. So we have 10 staff who are at board level, and we have 20, let's say, pro bono, newly retired people from the banking industry who are also supporting our partners. For those people, for instance, it's much harder to engage this topic because they come from the typical financial industry. They're more interested into financial KPIs and stuff like that. So it's the first work that I have to do is to engage them with this subject, and ensure that they understand what CD is actually seeking to do, and how we try to do that, despite the fact that, as I was mentioning earlier, very often we operate, or partners operate in very complicated areas where there are very few microfinance, financial service that are provided to the population. And for instance, we're invested in equity in Goma, in Ekima, and where there are 2 million refugees that have settled around the city, and I can tell you that there is all the less investor willing to invest in microfinance institutions operating in this area, while it's exactly now that they need our support to be able to provide financial services to all those people. And when it comes to adapt for those institutions, the issue is to adapt to the situation. So provide loans to refugees when they have the capacity to do it, which makes it even harder to tackle this issue of client protection. So this is where we try to engage with our board. Sometimes we have successes, sometimes we do not. It's true that often, as minority stakeholders, we have a limited capacity also to, of course, to ensure that the board is motivated by the subject. Very often, we have other minority stakeholders which are aligned in terms of, investors which are aligned in terms of vision. So we try to, of course, engage with them and ensure that we're all pushing for the same subject, including client protection. We ensure when we invest that there is an SCPM committee that is created, and we ensure to have a seat at this level. And this is how we start to ensure, push client protection. Client protection is not the hardest topic, in our opinion, to push, despite this complicated context in which we're invested, because there is a very direct material effect, on risk management at portfolio level. So it's always a type of approach that we have. We really focus on direct effect of client protection, showing, or at least advocating on the fact, that they're going to be a direct return by investing into this subject for microfinance institutions, so that they understand, that it's not something that is theoretical or something that is reduced to reporting for like some kind of crazy institutional investor. And it's often a discussion that we need to have, because very often we are the first international investor also to invest in our partners. So we have to explain them what it means, to have an institutional, international investor, not institutional, but international investor on the board. Yeah, so, and yeah, there are ways to present things, you know. If you say, okay, we're going to do client protection, okay, maybe they're going to look at you with big eyes and say yes, but at the end of the day, nothing is going to happen when it comes to practices on the field. But when you speak about, you know, how you should manage your portfolio risk, which means that you need to be able to, you know, be transparent on the pricing, to understand the repayment capacity of the end customer, where they understand that much better, actually, than a theoretical framework. So, yeah, we are very practical in the way that we engage them.
That's extremely interesting indeed. So what I hear is that the client protection standards are something like a concept, very vague, and what you are trying to do is like to translate this into a language that the FSPs you're working with can understand and materialize it in their day-to-day operations. And I think also, Gojo, you would have an example where you translate through capacity building initiatives what your vision is with client protection values into something that is more manageable and understandable by boards and management, right?
Yes. So the situation is a little bit different because our strategy is to be a lead shareholder. So by doing so, we try to streamline the governance with structuring subcommittees. So whenever we are controlling a shareholder, we have 3 subcommittees that we implement and where nominees directors have to sit. So there is the risk, audit, and SPM. The nominee directors of Gojo, they always have to sit at the SPM so that they can drive the performance from within. So in addition, actually, to the SPM team that is quite dedicated, one person of the SPM, there is also the nominee director that ensures its proper implementation whenever there is some monthly catch-up on SPM for a specific partner.
Okay, and I think you had an example of how you, through training, how you made client protection more concrete for boards. And when we were preparing the panel, you told me about this training that board members went through. Would you like to present the training?
Yes, actually, it was a training that was more dedicated to the CEO and CFO of the partners. It was the team, my colleague, Arya, she came back from a SPM training that she received from Cerise+SPTF, and it was a role play and a situation where a client officer was being pushed to do some aggressive sales in order to fulfill both high growth net targets. And from this role play, it was different perspective, point of view being shared, where it was the branch manager, the lender, the board of directors, the clients, etc. And it was a confrontation of opinion and see what unraveled from this situation that was just reaching out to only profitability. This training was such a success that we decided to put it in the offsite. So we met in Tokyo last summer, and all the partners of the group companies came. So it was CEO and CFO who came and who were involved in this role play. It was very interesting because the discussion that arose were highlighting a lot of cultural differences, different point of view from people who can be only working with numbers, such as CFOs, and somehow it was helping them to put the reality of the market into the numbers and to translate that we can't push only numbers, but we have to also keep realistic to the ground. And in addition to this, the training was so well welcomed from every staff member, every members from the offsite, that we decided to make this training mandatory also for the staff of Gojo Holdco, so that people, even like me working from a Holdco, are able to keep ground of the reality of the market.
Okay, thank you for sharing this experience. So we've understood here that you try to, when you enter in as an equity investor with an FSP, you really want to partner, and that's interesting, whether you stay minority shareholder or majority shareholder, bring the FSP towards a path that is aligned with your values, taking an active role on the board to embed this client-centric culture in the board. So we've covered this part, and now I don't want Daniel to fall asleep because we didn't give him a chance to speak yet. But let's look as well. I think it's an interesting and very important topic. You've done a lot of research on exits and how can they be responsible. You published a paper earlier this year that is called Rethinking Responsible Equity Exits, a call to action for impact investors. If you haven't read it, you should read it. And Daniel will introduce it to us. Can you briefly describe the recommended approach that you come up with in this paper on exits?
Absolutely. So I remember when we were, even before this paper, there was an earlier paper that we did in 2018, I think, together with NPM back then and FIAC, which is the Financial Inclusion Equity Council, which is a group of equity investors. And so I remember during that time we had we interviewed many investors and sort of talking about, okay, what's the process of exiting? And one of them used this comparison, sort of thinking about, okay, when do you decide when to exit? Which is one of the key questions. Was well, you know, you kind of have this relationship with the FSP that you invest in. They're kind of like your child, and once they outgrow your abilities as the parent, you know, you're too small, or maybe you're a fixed term fund and you need to start exiting, you kind of see the child off and into the world, and then they grow, and then maybe you're watching them get married, and you know, and it sort of made me think, it's like, well, yes, that's true, but there's one interesting distinction. So at the time, I had a friend who was from India, and he was getting married, and in that case, you know, those of you who are familiar with South Asia, the marriages are quite different. It's actually usually arranged by the parents. And I thought, well, actually, an exit is really like an arranged marriage, right? You as an investor are not there to see the child off and prosper. No, you find the groom or you find the bride and you say, that's the one, because, right? And really, so the responsibilities are very much on your end to figure out, okay, how do I pick the right groom, you know? And I think, so one of the call to actions is to really start thinking about, imagine for a moment, right? When you're selling, let's be realistic, right? You're selling for money, right? And in the case of marriage, that would be a dowry. Okay, we might look down on dowries, that's fine, but in principle, that's what we're talking about. We're talking about the new shareholders are going to pay you for the shares of this institution. And typically what investors tend to do is they tend to put out a bid for call for, you know, here's this institution, there's a sale, put out a call, and they field the sort of the offers, and they will look, okay, here are the offers, and they'll take sort of usually some of the top offers, and then they will run it through, okay, are these the suitable, you know, do they pass sort of the test of suitability for client protection, for social responsibility, and so on. But the first thing they look at is actually, first, the bid. And imagine if for a moment, if you were a parent of a child and you're arranging this marriage, the first thing you do is like, okay, let me take the highest, you know, offers, and I'm going to take the highest dowries, and then I'm going to see, okay, yeah, that guy's good enough, okay. And so our thought was actually, let's reverse it. What if you were to first say, hey, who are the best suitors? And then say, okay, among you, okay, what would you bid? Because you still have to talk about money, right? That's obviously the process. And just simply reversing that process makes a huge difference. At the end of the day, you look at both. You look at suitability and you look at the financial offer, but which one do you look at first makes an enormous difference of where you end up. So that was kind of one of the things that we really focused on.
Okay, great, thank you, Daniel. I think your paper has inspired, from what I understand, has inspired Gojo. You recently updated your investment policy.
Yes, thank you, Daniel. We were very much inspired by this wedding stories telling. So we actually amended the investment policy of Gojo last month, factoring this responsible exit. It was largely inspired by the recommendation you were making. So in a nutshell, it's differentiating which type of due diligence you should carry out, whether it is a minority divestment or a majority divestment. So there are all 4 criteria for minority divestments, such as the buyer should show some demonstrated commitment to client protection, or buyer is able to bring strategic value to its investee. And in case it's a majority divestment, all the minority criteria should be fulfilled, as well as some other criteria, such as the buyer capacity to provide financial and non-financial resources to the partner's company. So while Gojo's strategy is not to exit, it's good that we have this in our policy so that we can prevent any damage for our client.
Okay, and on Bio's side, how do you structure the process of exits?
Yes, I would like to say that each exit is unique, as every child is unique. And there is not a recipe that applies for all, at least in our experience. For us, exit start early. What I mean by that is that we want to have this conversation with the sponsor early on because, as I say, we provide patient capital, so we have an exit horizon of 5 years or 10 years. There is not a hard deadline, so that means that we have been in situations where there is a crisis in the country and maybe we arrive, to our end of our exit horizon, but it's not a good time to exit, and then we just don't exit. So that's okay. But at a certain point, we will need to exit. So what we do is to try to reflect an exit roadmap in our shareholder agreement, so we have the opportunity to discuss with the sponsor how we can facilitate and how we work together towards our exit. This could be a put option, a majority sell, an IPO. I think having this conversation is going to facilitate the exit process, because an exit process is heavy, it's challenging, and in certain markets it's even unpredictable. In terms of how we structure that, I say the shareholders' agreement should include an exit roadmap, and we have an exit committee, basically, that is going to help the process of exit. So we are going to accompany the exit process, and at a certain point, of course, we are going to select the investors. So we look at different metrics. We look, of course, the fact that the potential buyer have the financial means, but also the capacity to create value for the company. I think those two are important. We assess the commitment of client protection. We assess the cultural fit as well. And of course, reputational checks and so on. So everything is seen as a whole package. Everything is important, I think, to ensure that the company will be in good hands. And so maybe what I would like to say also is the fact that responsible exit should start in day one. Because if you want to do a responsible exit just, at the time of exit, it's too late. It's too late. So it's a really long process, and it's linked to some actions that making CPPs allied at the heart of the organizations. So management, I think, is your best ally to maintain and to ensure the continuity of the social mission of the company. And I think maybe something also to not underestimate is the role of regulator. I think we have some challenges in certain markets, and the regulatory risk could be high. To wrap up, I think exit process takes a lot of time, a lot of energy, not always as planned. And I think in turnaround situations in certain countries, the theory is there, but the practice, unfortunately, it's a challenge.
Indeed, and I think that at the back of our heads, we all have the same country in mind, and that makes an excellent transition, because there's one thing I read in your paper, Daniel. You write, in overheated markets, a small handful of investors can effectively set the tone for the market in terms of exits. Can you explain why? Absolutely.
So, and actually, the market I'm going to think about is not the one we're talking about, which is right now. It's actually going back some time. So if you think back to the time of India in the mid-2000s, 2006 up through 2009 or so. This was a period of a really big focus on equity investors coming in, investing in institutions that had just a couple of years ago been NGOs. Most of them transformed around 2005, 2006. And so these are the first set of shareholders. And there was kind of an idea in the air at the time to say, hey, we want to commercialize the space. We want to show how microfinance is a real legitimate asset from an equity standpoint, and that meant looking at exits. And those exits were, so the first one was an IPO by SKS in 2010, which was at the time the largest MFI. And if you think about how many shareholders are we talking about? We're talking about a small handful. 3, 4 of the lead shareholders, and among them probably one that's really the main driver, because that's what often tends to happen. And that idea of we want to showcase this as an asset class and show returns, and these are venture capital investors, led them to, so if you're trying to showcase something as an investor, you're really looking at two things. You're looking at profit, which is margin, right? And you're looking at volume, which is growth, right? If you get, to the extent you're maximizing both, it makes an attractive investment. And you saw this massive growth over that period, where every single year, the institutions close to doubled each year over a period of 3 years. And so by the time you get to 2010, you have the IPO. IPO was very successful. There were other MFIs that were actually already starting to plan their IPO 6 to 12 months after that. Of course, what came was the Andhra Pradesh crisis, the whole market collapsed. And so the way I'm talking about how a small group of investors sets the sort of the standard is what you had the investors of this first MFI, SKS, the sort of the largest at the time, also one of the fastest growing, and the one with the first IPO. You saw the pattern of other MFIs trying to emulate that, because you're in a competitive market. And of course, if these investors exited successfully in an IPO, well, then we should do the same. And so you really have this effect of, at the end of the day, probably a half dozen to a dozen people, working at these main investors actually set that, process in motion. And I think you see it in other markets. Obviously, I don't want to say every market is the same. If you look at Cambodia as an example, today, many more institutions are involved. You don't have IPOs. The nature of exits is different. But at the end of the day, we're still talking about a small number. Yeah.
And with, in the end, with a terrible effect on the clients, on the populations that were served, indeed. Yes, I'm sure, and I'm sure that we have plenty of other examples to mention, but I do want to afterwards leave some time for the audience to ask questions. So let's move on, and we will continue discussing these interesting topics if we have the time. Now that we've looked at practical examples from the due diligence and selection screening process through the role of the board in the investment term, and also the active effect on clients that exits can have, let's talk also about tools. And at Cerise+SPTF, we published a state of practice report. Let me see if I have this on the slides. We published a state of practice report on client protection. For those who don't know, we have now 8 client protection standards. The client protection standard number 8 is really the most important. And it's this one that you see on the screen about the committed governance and all the systems that support the governance in being informed and being able to direct and orient the strategy of an FSP towards better client protection. We found in the analysis of the data that we have that this standard scores still very, very weak. I think I have the data here, indeed. So I invite you to go and see on a website this publication, State of Practice report, that indeed showed that there is a pressing need across all categories and regions to build capacity of board and managements and involve them into these client protection topics. We had at our annual meeting in Manila this June, we had a full-day workshop with 75 board members, CEOs in the room to discuss the importance of client protection topics. And what was really enthusiastic for me was to see how they realized, and that's what we talked about also, these people, all these people in the room realized how, in fact, it made full sense to have certain topics on the agenda. So client protection, again, is not just a vague concept. It's also something that can have a direct effect in risk management, as you said it earlier, Jan. Indeed, and when you translate it into something that makes sense for the business and for the performance, then yes, the board feels more interested and involved in this. So, this having been said, I will probably leave this on the screen for people to take notes. I know that, well, when we prepared this panel, Vidari, you told me about an excellent example of what you call the financial diaries, and I felt that this was somehow one of the tools that could be of interest for the rest of the audience that could support, you know, understanding the client protection practices and improving it.
Yes, indeed. So financial diaries are, it's a quantitative data research that we've done in 2 countries, in Cambodia and in Sri Lanka. The purpose is to go through 100 to 150 households where we analyze very thoroughly their cash flows. So not only we analyze the cash flow for income expenditures, but every type of cash flow that arise, which can be also crisis management, etc. The purpose of that is to understand the effectiveness of the loan impact and to also help identify what are the indicators that could help to with the income management. So in terms of process, there are 2 people at Gojo who are dedicated in doing that. They spread the analysis in 1 year, 6 months to 1 year time frame, and the results actually are available on our webpage, and we did also some webinar to share the expertise around it that we have received. In a nutshell, the key findings is that it turned out that these loans were not solely used for business investment as we could simplistically assume. The broader picture reveals that there is much more layers which were involved, and business investment to personal consumption, emergency expenses. So our analysis is actually very interesting, very informative at the moment. The only problem is that it could be interesting to make it actionable at board level. We still didn't find a way how. For example, in Sri Lanka, we are discussing about designing a new product based on these findings, a gold product because of these financial diaries, but we are still processing how to make it actionable at the board level.
Okay, great. Thank you very much. So I do, yes, I think now is also a good time. I imagine that in the room we do have a few questions. Is there another microphone, or should I pass this one? Yes, please, there's a question here at the front. Thank you.
Hello. Yes. Thank you very much. It was very interesting and insightful to have the comparison between marriage and investment. That was a great thing. I wanted to know about your main challenge, which is to include standards, into governance and management. Do you go as far as setting incentives for the management to respect client protection standards? Because they're very keen on numbers, so would that be a way to incentivize them?
Yes, that's an excellent question that I will revert back here. It's indeed in the standards, in this standard number 8, there is an indicator that says that the board should hold the management accountable for putting in place client protection strategies. So turning this question to you as practitioners, do you have concrete examples of incentive systems to hold the management accountable?
Yeah, maybe I'm trying to think how this was in the practice, but I think in one institution that we work, we as I said, we managed to have some metrics, so financial metrics and also social metrics. So if those are achieved, of course, the management expect that there is a compensation for that. So that was possible, and also I think we work with an ESOP for employees. Was not exactly linked to only CPPs, but overall to top management to be able to become shareholder of the company. That really helps in terms of having the key people fully aligned and fully motivated with the financial, but also of course with the social mission of the company. So ESOP was for us an answer to for achieving more engagement.
Some other questions? There's one there, and then you.
Hi, thank you. I'm Nicole Guarneri, independent consultant. I'm thinking about some very complicated context, like, I don't know, coming to my mind Bolivia in this moment where there is a shortage of US dollar and where it's so difficult to take money out of the country, and banks charge up to 70% of fee for transferring money. And I'm thinking in this challenging context that are growing, inflation is very high, devaluation, how can, I know it's a difficult question, but what can we do, and how, I think I really appreciate to see how you are responsible in investing and de-investing, but I'm wondering how feasible actually is to remain responsible in that context, and which could be the strategy to deal with that.
Sorry, Mikkel, just to clarify, you mean in the moment of exiting or throughout the whole term?
Exiting is even more complicated, but even adding back a part of the lending that you provide. In this moment in Bolivia, to transfer US dollar back to investor, or EMFP back to investor, for example, banks charge very, very high transfer fee. So it's a problem for the institution to give back money to the investor, and for the investor to receive what he have lending to the institution. So I was wondering if you had this kind of issue and how we can deal with it.
Was it you yesterday, Jon, who mentioned that you invest in countries where you know that the money will never come out?
So you have to have innovative solution on how to use that money.
So what Mikkel is discussing is something that is very concrete for CD because we're investing in Bolivia. So it's there is no good solutions here, and it's about limiting the losses and making bet on the future. When, as far as CD is concerned, it's about staying longer, and hoping that the situation is going to improve at one point, because we cannot just exist right now. So this is the position that we are taking, even though it comes with the costs for sure.
Thank you. Yes.
So I am Rohidash from Bangladesh. So in Bangladesh, for client protection, really we follow a citizen charter, which is really given by the regulatory authority and also is developed by the organization. There the clients can find their rights and the information they asked, the services they asked, and which is that around the time frame, it is also mentioned. So it is strictly followed in every branch, there is a citizen charter. A client can ask any kind of service within this. And also for our staff, we sign a code of conduct where how they will deal with the clients, it is also mentioned. Also organization values, these they have to follow. And in our country, some of the organizations, they include client in the board. My question to Bidari and Milena, do you have such system that the client is coming as a member of the board? Anything?
I'm sorry, I'm not sure I understood the question. If you,
A question,
yeah.
I can mention again.
Yes.
Normally in Bangladesh, I have seen some of the organization, they include 1 or 2 members from the client into the board as board members, like for 2 years, for 3 years. They said if they are in the board, so the clients will get benefit from it and their rights will be honored. So this is the one system. Do you also have such system?
Do you have clients on the board?
We don't, no, we don't, no.
No.
Yes,
But that's an excellent idea, and one of our colleagues and friends, Deborah, who she regularly tells the story that having even if you don't have a client at the board, just materializing it. Sorry for my English, with just a seat, and having holding the board meeting with this empty seat that illustrates the client being around the table with us, that makes also everybody think twice also, or think differently. So it's an interesting solution, like, because we want to. Daniel?
Yeah, actually, so I do remember, and going back to India again, there used to be a practice when the MFIs transformed, they would maintain the original sort of, so let's say you're an NGO, you're transforming to a for-profit entity. The assets of the NGO got transferred into these trusts, and the trusts were held in the names of the clients. In some cases, you had like millions of clients that were technically owned shares through the trust of the MFI. And the problem with the governance is, the reality is, if you actually have a client and sit in a board and make decisions, there can be real opportunities for, to what extent the client is really representing the clients, and to what extent is the client actually just following the direction of the CEO, for example, because there is not a real relationship. So I'll be very curious how it's implemented in Bangladesh, because I think the concept is really great. I think the implementation is crucial, because the risk of potential corruption and things like that is real as well, right? Because you have to ensure that the client truly is able to represent the clients and doesn't feel obligated to just do what the boss tells the client to do, because too often that's what happens.
I don't know if we have examples at CD level, but we don't have only very complicated situations. We also have very nice and interesting champions, which are very committed to the clients. For instance, ENDA in Tunisia. Most of you are aware of this organization, which is market leader, which is very profitable as an organization and extremely socially minded. One of our staff is sitting at the board level and at the ACPM committee, and ensured that the last 3 years, profitability is shared with the clients by reducing interest rates. So it has been 3 years in a row that ENDA is actually reducing its interest rate towards certain types of clients, the one that they are targeting the most in their social mission, women, agriculture portfolio. So those who they consider the most fragile. And I think it's an amazing example of what strong governance can do in the context also where the stars are aligned, which is not always the case, of course.
Yes, so just to say it again, ENDA in Tunisia was this example that he mentioned. There was a question at the back. Here. Okay,
yeah. Thank you, Fatine Hura from Entrepreneur du Monde. My question is about key indicators of client protection. As a board member, for example, we have 4 or 5 meetings in the year. How many times concretely, the manager has to come back, has to give us feedback about client protection? By year or each 2 years, or concretely?
Well, from our side, we set up a quarterly SPM catch-up. So it's we try to have it very regularly. Yeah, so that's discussed through the SPM committees, and then it goes directly to the board.
Yeah, in our side, we have an impact committee, and basically what we do is to try to have a more focused discussion on impact topics. So we have some members of the management and also some members of the board. And then there is a discussion about CPPs, but not only, it could be if there is a gender project, if there is a climate project, we'll be discussing there, and then upstream to the board of directors, so every quarter as well. Mm-hmm.
But just to clarify, in case there is a country where there is more issue or we need to follow up more, for example, in Cambodia right now we are having it on a monthly basis because we did a turnaround plan. We work on some new plan for the company, financially wise, SPM wise, and we are having this a monthly catch up right now. So it really depends, but minimum is a quarterly. Yeah.
Hello. Yeah. Perhaps the same reaction. Yeah, I wanted just to react to the question from our colleague from Bangladesh regarding the representing clients in the board. There is this cooperative model, and that is exactly created for this. I'm myself member of a cooperative. Half of the board are clients. Chairperson is a client. So these are member-based organizations. They do have this governance model, but it's true in the financial cooperative sector today you have this fit and proper test. So before having people elected in this, they have to go through a whole process of training before, and it becomes more and more difficult sometimes to find the people not only with the right mentality but also the right financial skills in financial co-ops. But this is a model that is meant for having the voice of the client by governance in your organization.
Thank you. Was this intended also as a question or a comment? Okay. And I guess that's very common in Germany, indeed. Is that what you think? And also in West Africa. You wanted to add something?
Yeah, I would like to elaborate on what Marc Laby from CERMI. I would to elaborate on the image that Daniel was given and on the previous question. How many times in where you are invested in equity did you get out of a financially successful institution because there was client protection issue? Has it ever happened? And if it has not happened, how many times have you, I'm not really asking a figure, I'm just asking, does it happen that you really get into a conflict about who is the management, changing the management, replacing the management, whatever, just because when the institution is financially successful, just because client protection is not appropriate?
Trying to think a concrete example. I think, yeah, I mean, it has happened that we have changed management for many reasons. But I think you need to see it as a whole. If for me, the management have a strong role in terms of leadership, in terms of not only financial performance, but as I say, also in terms of being the person who incarnate the social mission of the company. If that's not the case, you might have some questions, you want to discuss with them, and I think it's important that to have a long-term view as well, to have a long-term view of the company, because the company will go through many challenges, of course. At certain point, the CPP's framework won't be perfect, and it will be some issues, that's for sure. So you want to really investigate this, you want to be there, you want to be hands-on, and I think it's not a culture also of only blaming, but also, if there is an issue, you as an investor also has a responsibility, so you want to understand what went wrong. I don't think we have a case in which exactly we have dismissed a manager because of CPP issue. But I think overall, that's what I can say. I think the questions are not only at the management level, it's a larger responsibility, I would say.
From our side, we actually didn't exit. It's not the strategy of Gojo to exit. And the only partial exit that we've done was because we split it and we created a subsidiary focus on venture capital, but we didn't do anything like that.
So on our side, as I was saying earlier, we don't have any investment horizon. In our exit strategy, the only thing that is mentioned is that we should exit organizations which are drifting away in terms of social mission. And then we are facing two practical issues. First, that on our market, there are very few opportunities to exit, actually, because we have very few investors. So each time there is an opportunity, we look at it. But very often we stay longer. This is what happens. Another situation which is very classical is that we have private equity investors with us, and their mindsets tend to change when they get to the end of the fund, and their priorities tend to change. So this is difficult that we're facing because, of course, we are not interested to, by their own agenda. And this is when the discussion can get a bit tougher, of course, in our experience. But I don't have any quantitative figures to give.
Okay, we'll take one last question over there.
Thank you. I'm Arno,
two.
working for FMO, and FMO makes equity investments in MFIs with the purpose after some years to exit. So we do have an exit strategy, and we do want to do that as much as possible in a responsible way. A very practical thing, we are a shareholder in Amret. We have disclosed that we will sell that to a Taiwanese bank, Sinopec. It's almost 99% done, so we hope to do it to make the closing in a few weeks' time. And then the idea, we sell it to a bank. How do you do the responsible things? And how do you force this bank to comply with CPP? And we were very surprised that the bank itself in Taiwan, Sinopec, already had subcommittees in their board focusing on CPP. So we put that in the new shareholder agreement of Amret. Together with IFC and FMO, we do not sell completely, we sell in phase-wise, in 2 years. And in this 2-year period, we also feel this is a kind of period where we can condition responsible CPP compliance. And Sinopec was completely in favor of that. The existing Amret board did comply new CPP principles based on mistakes or how do you call that, experience where we thought we could improve it. And Sinopec did completely accept that. So in the new shared agreement, the CPP committee for CPP the coming years will make this the best microfinance bank in Cambodia. That's the idea.
Actually, thank you very much for your testimony. Actually, your case was discussed when we were preparing the panel. And what I would suggest is simply to invite you in 2-3 years, and then we can talk about lessons learned.
Yeah, more than welcome. We'll do.
And maybe if I can just very quick, there's another example that I find really fascinating. So in 2018, you had an exit from AMK, which Incofin exited. And I just checked, and I was curious. So to this day, they still sit on the board. Incofin still has a board seat at AMK, despite having no shares. They're just as an independent board member. I think that idea of maintaining a relationship because you sold to a counterparty that that kind of has the same, shares your vision, is really valuable. So I think just as a model, I know you sort of have a transition, Arno, in your case, but I think that idea that, you can maintain that relationship going forward is quite valuable. Yeah.
No, fully agree, Daniel. And we have not yet discussed with Sinopec whether we keep our board seats after 2 years, after complete exit. But the coming 2 years, IFC and FMO are the chairperson of that CPP subcommittee in the board.
Hello. My name is Ulrich Reinecke. I'm with Gogler. We're the Off-Grid Solar Industry Association, and we have a consumer protection code, which is very much inspired by Cerise, so thank you for that. My question is, we are thinking of expanding that consumer protection code to something which we call the responsible business guidelines, because there was, you mentioned climate protection, for example, but climate protection is not currently one of the standards that is included in the slide that you've shown with these 7 principles. So what are your thoughts, or how does the panel see the need to strengthen and maybe even expand those standards that you were showing here? I don't think we have time. I was also going to ask the question, what aspect concretely would you like to strengthen in consumer or client protection? But I guess we don't have the time for that. Yeah. Thanks.
Thank you for your question, and to be very brief and quick on the green aspect, on the environmental protection. What you just saw on the slides was just one little extract of the universal standards for social and environmental performance management. Client protection is embedded in our universal standards. Our universal standards have 7 dimensions, and the number 7 is around environmental performance management. So this is already included, and we are very happy to be able to work with you and push this forward and update the standards as you learn experience. I think, unfortunately, we cannot get into your second question, but I'm happy to stay here and we can continue the conversation. So just to wrap up very briefly, I think what we've heard today, what I've learned, is that the board and the management are critical in setting the culture of an FSP, and as shareholders there is a very important responsibility in how this is transmitted, put into shareholders agreement. And I would just say that if there is anyone in the room who wants to support their boards or their FSPs in strengthening these capacities at board level, at Cerise+SPTF we have done plenty of trainings to board members, and we have the ability, to transmit these kinds of information. Thank you very much for your active participation this morning, and happy to continue the conversation. Thank you. And thank you to you. And thank you to my panelists.